Hello, fellow investors. My name is Ed Sinensky, and I'll be your moderator tonight. I represent Prudent Consulting. I'm here tonight with some business partners of mine, and more importantly, my personal friends, Dimitri Formachenko and Patrick Prunty. We're going to talk today about how you grow your wealth and create passive income. It's a wonderful thing, passive income. We're going to tie two systems together here, one with Dimitri and the solo 401k, so that you can invest tax-free or tax-deferred. And that's going to help you segue right into what Patrick has to offer, which is going to be notes for passive income. The notes for passive income can be in a retirement account, or it can be just taxable, because there's nothing wrong with creating regular income that you can enjoy and spend also. So we're going to start off with Dimitri. Dimitri is the founder and the president of SenseFinancial. Dimitri, like Patrick and I, has been a real estate investor for a decade. He has property in various states. He's a real estate broker. In around 2000, Dimitri was in the financial industry and was dealing with people, mentoring them on real estate, and just ran across a whole lot of people that wasn't happy with their retirement accounts and the stock market and how they were being treated, lack of control that they had over their funds. So in his research, he discovered what at that time was really a little-known IRS code that allowed people to do self-directed IRAs, specifically solo 401ks. And he's turned that in the last 15 years into a wonderful business. During this last 15 years, he's conducted hundreds of seminars. He's mentored thousands of people. And his goal is to maximize your returns while protecting your principal. So with that, Dimitri?
Thank you, Ed. Can you hear me well?
Yes, very well.
Okay, great. Well, folks, you have my contact information here on your screen, so should you have any questions, I do offer free consultation for all of the attendees. You can reach out to me directly, or my assistant will also be following up with all the attendees, so you can take advantage of that. Just very quick disclaimer, what I'm going to share with you about is just some of my experiences, and my area of expertise is self-directed retirement accounts. I'll be covering different topics though, but please understand that I do not provide legal, tax, investment, or accounting advice. All right, so before I jump into my presentation, I wanted to give you just an example, a very quick client case study. This is Jason. Jason is from Tallahassee, Florida. He found us online. A few years ago, he contacted us, and I had a consultation with him. Jason had a couple different retirement accounts valued about $135,000. He was actually losing money in the stock market, and he was concerned about government coming after him and just taking some of his retirement funds away because of the situation in the country. So he contacted us, and we had a consultation, and we set up a self-directed solo 401k plan for Jason. And right now he actually owns these investments in his 401k. He owns a property, a rental house that is rented, and all the rent goes back into his retirement account. He took some of the money and invested into his brother's private business. And also some of the money he actually took, and he became a bank. Patrick is going to be covering more of that in details, but he actually had someone who wanted to buy some real estate, and he had the money and he lent it to that investor, and he actually became the bank. So he's collecting about $1,000 a month in a cash flow that's going back into his retirement account. So from losing money in investments that he could not control, the stock market, he's now diversified into different classes of investments, and his account is growing every single month. So this is just to give you a flavor of what is possible when you are in control. Now, and if you have a retirement account And if you basically looking at your statements, and if you find yourself in a situation like this, this is actually credit goes to my daughter for this picture, but the man says, I finally decided to put something aside for our retirement, which is our plans to retire. So if you are in this situation, there is hope for you. There are much better options out there, and you can be diversified. You can get better returns on your investments. So what are your options? Your options are self-directed IRA and self-directed solo 401k. So let's quickly take a look at each one of those. Let's take a look at the conventional retirement account. If you, like most people, have some type of retirement account, it's actually held by a custodian. That could be Wells Fargo, Schwab, Merrill Lynch, Fidelity, and your investments are limited to stocks, bonds, and mutual funds. And this is just an example of typical 401k investment options, just maybe not even a dozen options that are available to you. But when you go to a self-directed retirement account, you've got basically almost limitless investment options. You can invest in real estate, tax liens, and tax deeds. You can do private notes and mortgages and trust deeds. You can do businesses. You can even buy real estate internationally. We have clients who purchased real estate in India, in South America, in Canada, and Japan. So again, virtually limitless investment options. So what is a self-directed IRA? Well, basically it is a tax-deferred trust account that is held with the IRS-approved custodian, and it allows you to invest in non-traditional assets. Majority of the people out there are not aware of existence self-directed retirement accounts, but they've been around for quite some time, since 1974, and they've been designed to help people like you and I save money for the retirement by giving you the options to diversify. So how does it work? Well, first you have to find a custodian that allows your account to be self-directed. It has to be IRS-approved custodian. And then step number two, you have to transfer your funds from your existing IRA, 401k, 403b, whatever account you have, into the new account. And then you, as an account holder, you tell the custodian what they want to invest in. So custodian acts as a middleman. They hold your money, and you tell them, I want to buy a piece of property, or I want to invest in this a trust deed or a mortgage note. The advantage is that you have the freedom to invest in whatever you want, but the disadvantage is that every time you conduct a transaction, custodian charges a fee for that. And also there are delays. You can't just execute the transaction. You always have to go through a custodian for that. So let's take a look at the solo 401k. What is a solo 401k? It is defined in the Internal Revenue Code section 401, subsection K, as retirement savings trust. And it is designed specifically for those people who are self-employed or own a small business. It's not a new type of plan. They've been around for quite some time. Basically, it's a traditional or conventional 401k, just covering the business owner and his or her spouse. But the increased interest in these types of plans was as a result of tax law in 2002 that made all of the benefits that I'm about to share with you possible. And so let's take a look at that. And before we do that, let's take a look at the eligibility. So there's two things that you need to remember to take advantage of solo 401k. You have to have some sort of self-employment activity, pretty much in any shape or form. And then number two, you cannot have anybody work for you full-time. And the full-time definition in the IRS ICE is somebody who working 1,000 hours or more a year. So if you're self-employed or own a business, and if you don't have somebody working for you more than 1,000 hours, you qualify and you can take advantage of that. Now, how solo 401k works. So the first thing, you need a plan sponsor, and that's either a small business, which can be in any type, any legal business qualifies. It can be a corporation, LLC partnership, or just you as a sole proprietorship can adopt a solo 401k. The next step is solo 401k plan adopted. The plan and the trust is created. We create a trust that specifically is designed to hold assets of the plan. And you become the trustee of the plan and plan administrator. So as a plan trustee and plan administrator, you control the trust and how it is investments. So there is no middleman. There is no custodian now. You can just open up a trust bank account in the name of the trust using a trust tax ID number at any bank or financial institution or brokerage. And all of the investments are now made in the name of the trust. And all of the income and expenses is going back and forth between the trust bank account and the investment. So there is no one in between. You are 100% control over the plan assets. So it's pretty cool. It gives you a lot of control and a lot of flexibility. Now let's take a look at the benefits of the solo 401k. Number one, it allows for significantly higher contribution limits compared to an IRA, which is $6,500, here up to $59,000. It allows you to borrow from your retirement account up to $50,000 or 50%, whichever is less, before you retire. So it's a great way to become your own private bank and have access to the funds should you need it. Next, it allows you to actually contribute into a Roth 401k sub-account up to $24,000. Compare that with $6,500 for a Roth IRA. And also it offers you a checkbook control feature and very cost-effective administration because there is no custodian required. You as a client and trustee of the plan control the plan, and there is no additional cost for spousal account. And then it also exempt from unrelated debt finance income tax if you finance investment property inside of your retirement account, and that is not the case with self-directed IRA. If you only invest in the stock market, then you need to be afraid of a picture like this. See, wife says, I thought that our investments were diversified, but they were actually in one basket. So if the button falls out, then all of your eggs will be broken. So it's very wise to diversify. Ecclesiastes 11:12. This is a book written by very wise man thousands of years ago, found in the Bible, and it says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. So this is, as you can see, there's a lot of wisdom in this. So self-directed means unlimited investment choices. You can buy real estate, you can buy precious metals, gold and silver. You can do hard money lending out of your retirement account. You can do buy commercial real estate and much, much more. There is only a few things that you're not allowed to invest in with your retirement account, and that is collectibles, which is can be stamps, coins, S corporation, and then life insurance contracts. And then also the retirement account is not allowed to conduct any business with a disqualified person. And disqualified person is basically yourself and your immediate family members. So I kind of run through my presentation because I want to bring Patrick in, and but you do have my contact information here on your screen. And if you have any questions, you can contact me. And like I said, I do offer a consultation for everybody. And right now I'm going to get Ed back in, who can introduce Patrick.
Thank you, Dimitri. That was a wonderful presentation. I know everybody's a lot smarter than they were before you gave that presentation. I want to reiterate that all three of us are longtime investors. I've been investing for 40 years in real estate and own property over a dozen different states. When I started investing in real estate, there was no such thing as a solo 401k plan. So, I missed the opportunity to invest tax-free or tax-deferred with real estate. And I just want to encourage all of you out there that are, 30, 40, 50 years old and still have 30, 40 years ahead of you. This is a tremendous a vehicle that is really relatively new, and you should all take advantage of it. So given that, I'm going to introduce Patrick Prunty to you now. Like I said, Patrick is a real estate investor. He owns property in 7 different states. He's a real estate broker. He's a certified lender. He's just a wonderful young man who I've known personally for about a dozen years now. Time has really gone fast. Patrick has invested his own money in scores of deals, lending deals. He's organized, he's originated, he's evaluated, he's funded, and he's closed hundreds of loans. And while there is no such thing as no risk, there is such a thing as limited risk or low risk. And I think this definitely qualifies on the low risk scale. In all of the time that Patrick's been involved in this, he's not had one loan gone bad, which I think is a tremendous reputation and something to be proud of. So given that, I'm going to pass the microphone over to Patrick Prunty.
Thanks, Ed. Really appreciate that introduction. And Dimitri, thank you so much for the information, too. I'm so happy to be here tonight. For all of the investors on the call, I'm just so excited to be here with you tonight and to share this information with you. I also wanted to just point out, bottom bullet point I have on the screen now, that I am a Sense Financial client. I think 4 years ago now, this is back in 2011, Dimitri helped me set up my self-directed retirement account. I'm not a self-employed individual, so I don't qualify for the solo 401k. I had to go the IRA route, but I set it up with the LLC arm so that I had the checkbook control. And my original purpose in setting that up was to buy real estate with it. I wasn't happy with the returns I was getting with my financial advisor, and I'm a real estate investor, and it was an option for me to do it. But after that, I realized that managing property inside a retirement account isn't the easiest thing to do, and I actually found that being the lender, being the bank, was easier and preferable to me inside my retirement account. I'm also doing it now outside of my retirement account because it's completely passive. Owning rental property is passive, but it's just not as passive as playing the bank. So my motto is, lend and collect versus borrow and pay. In either case, you guys are all here tonight. Whether you want to buy property or you want to play the lender, you're here for 2 reasons. You want to educate yourself, and you want to take matters into your own hands. So put up your dukes. And with that said, I'd also like to take a poll. We're going to be a little interactive tonight. The first poll, hopefully we can get these to work. It's something new that we're putting together. But Dimitri, if you can share the first poll with our investors. Well, I'm not sure, guys, that it's going to work. If it doesn't, we'll continue on. I will read the question, though. Since investing for retirement, what has been your average annual return? And the questions were 0 to 3%, 4 to 6%, 7 to 10%, or above 10%. So in any case, for tonight, the topic and the concept that we're talking about is to become the bank and to collect mailbox money. Now, like I said, that's a mentality. It's really a state of mind, and what I want to hammer home is the passive income. You need your investments to be paying you every month. And there's many ways to do this, but tonight I'm going to be showing you to safely and securely lend for a return, and most importantly, with very little risk to principal. Right? Because as investors, we want to protect that principal, but we want to earn a good yield. And lending or investing in notes is an excellent way to do that. So a fun quote for today A group that I work with told me this recently is consider a more passive investment, diversify your portfolio, so become a lien lord as opposed to a landlord. And if you're not sure what I mean by lien lord, you will at the end of the presentation. So before we go further, you guys have to understand the firm that I work for is Marshall Reddick Real Estate, and I want to tell you guys a little about what we do. It'll kind of bring the presentation full circle. So Marshall Reddick is a residential real estate investment firm founded in 1979 by Dr. Marshall Reddick, who, by the way, today is his birthday, so kudos to Marshall Reddick. In any case, he's now retired and moved on, but point being, we've been in business for 36 years. We make it our business to help you create and grow wealth, real wealth, with real estate. Diving a little bit further into that, we've traditionally helped the investor buy and hold, find excellent rental property. You know, in the last 20 years or so, we've moved outside of California. The prices have risen substantially here, as we know, in California, and it's just not affordable from a rental property perspective. Moving out of state where the numbers make sense, we've really built some phenomenal relationships, and these relationships are what I like to call the power of Marshall Reddick Real Estate, and it really sets us apart from everybody else that's out there. So on the map you can see here, this represents the markets today where we have an existing long-term relationship based on trust with what I call boots on the ground. All right, again, this is the power of Marshall Reddick. So for those of you who have invested out of state and away from home, you know that having boots on the ground makes all the difference. Having somebody that you can call that you know and trust, it sure beats a Google search. So for me, whether it be Joe in Phoenix, perhaps Ryan Tucker out in the Memphis market, or Jim Moody in Toledo. These are the local market professionals that I work with and that I have an existing relationship with, where we can find excellent property and set you up with note investments. So we're clear, this presentation for tonight and the notes that we're offering, this is not a syndication type investment, so we're not pooling investor funds into some type of partnership. This particular program will pair you with a Marshall Reddick client who wants to be the landlord, who wants to do the buy and hold investment. Or we'll originate the loan ourselves. We'll lend the money and you can buy the performing trust deed or mortgage from us. And then you can play the bank and collect the monthly payments. So some key terms to know moving quickly through here. This might be a review for a lot of you, but a promissory note, simply a written contract where a borrower promises to pay a stated sum to the lender under specific terms. Some of the items on the screen here are what that promissory note will specify, including the principal, note rate, your monthly payment, when it matures. That's obviously important. You're going to want to know that, as well as any late charge, prepayment penalty, and what happens or when default occurs. Question for you. How does one invest in a note? Well, there's two ways to do it. You can become the bank and you can lend from the get-go. I call that a purchase money loan, so you'll do that at the initial acquisition. You're still going to have, of course, a trust deed or mortgage, which we're going to talk about next, and that document will be recorded during the escrow process. Two, as I mentioned, you can purchase an existing note. These are readily available for sale in the market in all shapes, sizes, and forms. Similar concept, there will be, I know a lot of you have heard of this, is called trust deed investing. That's kind of a buzzword that's out there. But in any case, the assignment of debt will be recorded in your name as the lender, and that will also be done through escrow, which is a third party. Trust deed or mortgage. Now, a lot of people know exactly what this is, but this is a security instrument. Okay? This will be recorded against the title of the subject property, and it protects your investment. right? It creates a lien that runs with the property. The borrower, therefore, cannot sell the property without talking to you first. It's recorded, and it allows for the sale of the property if the borrower is in default. Now, knock on wood, we never want to have that happen. And so far in our program here with Marshall Reddick Real Estate, it hasn't happened. We're very proud of that. But this is a secure investment, and it's a very low loan to value, but we're going to get into that and how we mitigate the risks and avoid the default. Quickly want to compare conforming or traditional loans that one would get to buy rental property or their primary residence. And you're going to be shocked at the similarities between being the private lender and, being a bank. So on the conforming side, we're talking about institutional money. We all put our money in banks, right? That's what we're supposed to do. They pay you a little or nothing in terms of interest, but they turn around and they lend your money, right? So we're generally talking long-term. We're talking the traditional Bank of America, Wells Fargo, or I've got AmeriFirst on here. That's kind of our preferred conforming conventional lender. Conforming simply means that these loans must conform to the Fannie and Freddie Mac guidelines. Now, the reason they have to conform is because these banks are selling these notes to Fannie and Freddie, quasi-government agencies, to replenish those funds. So that's what I mean by sold in the secondary market. On the private side, we're simply talking about private money. And guys, there are trillions of dollars sitting on the sidelines or sitting in retirement accounts, invested in stocks, bonds, mutual funds. It's staggering. So we can all do this. We don't need the bank to do it. Also can be long, short-term as well. Tonight's presentation is geared towards the longer term, a little bit safer, less riskier investments. But we do have some shorter-term programs that may interest you. Ed and I would be happy to talk to you about that one-on-one. We're talking about individuals here. We're talking about private retirement accounts like yourself, like myself. I use my self-directed IRA, and I fund deals, and I collect. The guidelines are not set by Fannie and Freddie. We're not concerned with selling our paper to Fannie and Freddie, so we don't have to conform to their guidelines. We can hold on to these and collect cash flow, or we can sell them if we need to at any time we want. And there's a readily available secondary market to be able to purchase notes secured against real estate with low loan to values. So some key information. We had another poll that we were going to set for now, but I'm just going to read the question. The poll was going to ask, for those of you who have obtained a 30-year mortgage, how long have you held it? And the answers would have been 5 years or less, maybe 6 to 10 years. Maybe you've held it for more than 10 years. But let me tell you guys something. The statistics show that across the country, 7 to 9 years is the average period of time that a borrower is holding their long-term mortgage because they're either refinancing it, which the original lender gets paid off, or they're selling the property when the original lender gets paid off, or they simply pay it off. So the point being is that while a 15 or 30-year mortgage may sound like a long time, rarely does a borrower hold their mortgage for that length of time. So we have 3 loan programs that we offer to our buy and hold investors. Now, I wanted to pause for a second and say, dismiss a misnomer that a lot of people have considering private lending. They always ask, well, why can't they get conventional financing and therefore they need private financing? Doesn't that mean they have bad credit? And that's simply not true. I'm going to give you 3 prime examples of where someone could have stellar A paper, 800 FICO, best credit in the world, but can't get a conventional conforming loan. Number 1 would be they want to buy inside their retirement account. So with that in mind, they need a non-recourse loan. There are specific lenders out there that will do it. NASB is one of those, North American Savings Bank, and you'll find that their terms are, we're very competitive with their terms, let's just say that. So that's option one, is when you need a non-recourse loan inside a retirement account. Option two, conforming guidelines state today that if you have 10 financed properties, you cannot get an 11th, 12th, or 13th, or even any more conforming mortgage. Fannie and Freddie will simply not buy it. So with that in mind, I could have $6 million in the bank and extremely low LTVs on my 10 mortgaged properties and collecting major cash flow, but I still can't get a conventional mortgage. Okay? And the third one is for lower loan amounts. Conforming guidelines and conventional lenders, they don't really want to mess with loan amounts under $50,000. When I say that, a lot of people that aren't familiar with investing out of state might say, well, when do you ever get a loan amount under $50,000? Well, it's very common in markets outside of California, New York, Seattle, areas like that. So jumping back to the presentation, the three purchase money programs we have available: 15-year fixed carries a fixed interest rate, 7%. And this is a good time for those of you who are considering playing the borrower. You can come through us and obtain a private mortgage at these rates. Okay, so 15-year fixed at 7%, 30-year amortized payment, but has a balloon payment. And we'll talk about the terms of those balloon payments in a second. But that particular loan program carries 7.5%. You can also have a straight-up 30-year fixed that carries 8.5%. Now, all of these programs, guys, they all require 40% down payment minimum. And I say minimum because the property must cash flow. So we will require more down payment, maybe 50%, whatever it takes to get the property to cash flow. Generally, however, with 40%, you're going to be sitting in a pretty good cash flow position as the borrower. But then from a lender's perspective we're talking about tonight, understand that you're only lending 60% of the appraised value, because all the deals we do require an appraisal if you as the lender desire one. We also have a 3-year interest guarantee. Now, that's not a prepayment penalty, it's an interest guarantee. Okay, so specified in the amortization schedule, when we're talking about funding a loan, there will be an amount of interest to be paid in the first 36 months of that amortization schedule. That figure must be paid by the borrower before they can refinance, sell, or do anything and pay you off as the lender. If they do that in advance, they have to pay that full amount before you'll agree and release your lien against the property. Okay? We also, of course, require homeowners insurance. That's must as a lender. You must have that if the property burns to the ground. You need to be listed as the mortgagee so that you are the loss payee. Quick snapshot on what those rates translate to in terms of payment. Okay, so what we're looking at here is based on a $100,000 purchase and therefore a $60,000 loan. I want to point you guys to the bottom of the screen there. It talks about the payments, rates, APR, and interest guarantee are based on a loan amount of $60,000 and 7% closing costs. So you can see what at 7% at the 15-year fix, what your payment's going to look like. And of course, the 30-year amortized, and again, I mentioned a 5, 7, or 10-year balloon, meaning that the payment's based on 30 years, but they have a balloon payment at the 5, 7, or 10-year mark, and it's the borrower who picks that, not the lender. I do have options available for you guys as lenders who want to a shorter term. We can talk about that. Okay, and then you can see in the very right, interest guarantee. So if you were to lend $60,000 on this $100,000 hypothetical purchase, you're going to be guaranteed that amount of interest on the right there. All right? So for the borrowers that are out there, and the lenders too, use our website, and you can calculate the numbers. So I got a little infographic going here. You first go to Reddick.com. You go to the Investments tab. You're then going to find properties that are there. And again, we only lend on Marshall Reddick approved properties and Marshall Reddick approved markets. So if it's on our website, it's approved. In any case, after you click on the link that's the property address, there's a couple tabs that are available that will give you a nice calculator. There's financing, cash, and private financing. You'll want to click the private financing tab. As you can see there on the screen, it pops out our 3 loan programs we just discussed, and you can calculate all the different numbers in terms of payments, returns. It's very, very powerful, all free, and I encourage you to take a look. Okay, how do we get started? All right, well, you'll have an initial call with myself or with Ed to express interest in being a lender or buying a note that's existing that's already been originated. We'll discuss how much you're comfortable lending and the source of the funds, which is important. Is it in cash? Is your retirement account already self-directed? If not, we'll get Dimitri involved and get that done. Is it in the stock market? Do you need to liquidate some funds? Many different options, but we're going to source those funds, okay? Then we're going to know a little bit about your criteria, what you're looking for, type of return, etc. Marshall Reddick will then locate, evaluate, underwrite, and present an opportunity that fits your criteria. Now, what does that presentation look like? What are you going to get from us? An example of a live deal that's going into escrow or an existing note. Okay, so this is an example of a live deal. This was actually just funded. Happy to say we closed this on Monday. So I mentioned earlier on the call, Jim Moody in Toledo. Actually, absolutely love Jim. I own property there that I bought from him. I lent against property there. Ed, our moderator, owns property there, all bought through Jim. In any case, this is an example of what we would present to you. Give you some information on the property, nice little Google photo there, a link to our website, the acquisition price, all the specifics you need to know about the loan. This particular gentleman was buying a $50,000 property, 60% loan, $29,000 and change. He selected the 30-year amortized 10-year balloon. Carries an interest rate of 7.5%. His monthly payment is $210. That's principal and interest. And the 3-year interest guarantee was a little over $6,600. We also show you who the escrow company will be. We've worked with all of these escrow companies for many years. They understand the program. We can close the deal. We're also going to show you the comps. Now, we certainly will have the borrower obtain an appraisal at their expense, but a lot of times we don't need that. As you can see in the comps here, we show all the subject property on the top line. These are all recent acquisitions. They're all close to the subject property. So we're going to share comps with you so that you understand the value, but we absolutely will have an appraisal if the lender requires one. We're also going to show you the amortization schedule, which I'm not sure if any of you out there have ever looked at your amortization schedule. I mean, get out your loan documents from when you purchased your property, and you're going to blow your mind at how the interest is front-loaded. So in my red box on the screen here, you can see that out of the payments on this particular property, which are about $210 a month, most of it is interest. Okay, it's incredible. So the banks are extremely intelligent. All the Wall Street money, extremely intelligent. They're lending their money. We need to take a page out of their book, you guys, and be lending for a solid, secure return. Okay, so that's what it's going to look like. That's the type of documentation you'll get from us, and we'll present that to you. You then get to review it. You get to ask questions, talk to Ed or myself about it, and then you commit, you say, yeah, I'll do it, or you pass. If you pass, we'll discuss why. We refine your criteria, and we'll continue the process of presenting available opportunities until you find one you're comfortable with. Now, let's talk specifically about how the process works. Once you commit, okay, you found a deal, we've presented it, we've talked about it, you're ready to go. All right, we're going to determine the vesting. Now, what do I mean by that? I'm going to give you an example. So I lent money out of my self-directed IRA LLC. That LLC name is the vesting. That's how my promissory note was written. That's how my trust deed was recorded. Okay? That's what the lender says on the HUD. It's my LLC. For you, it might be your solo 401k. It might be you personally. It might be a partnership that you have. Whatever that is, we're going to determine the vesting, okay? And then we're going to turn around and we're going to contact the escrow intermediary. We're going to explain to them, alert them that there's a lender involved in the transaction, and then we're going to move on. The borrower will get their appraisal if required. The escrow office, the intermediary, will obtain a title commitment. We need to make sure that the borrower gets clear title. We need to make sure that the lender gets a title policy. Okay? Now, when the documents are drawn, okay, we're talking about promissory note, trust deed. We have an attorney, state-specific attorney, draw all those documents. You as the lender, you might find this a little shocking, but you don't sign anything. Think about when you got your home loan for your primary residence. You as the borrower, you signed everything. You had that big, thick packet. The lender just approves the documents. Okay, so you won't sign anything. The buyer signs all the documents that you previously approved. All right. The borrower will also purchase a homeowner's insurance policy. And you as the lender, you'll be listed as mortgagee. Again, that's extremely important. You need to make sure that the property is sufficiently insured at all times to protect your investment, because natural disasters, they don't happen often, but they do happen. And if that property burns to the ground, it's going to be a lot harder for that borrower to repay that loan. But that's where the insurance comes in, and you will get paid from the insurance proceeds of that claim. Alrighty, and then ultimately we're going to get to the closing table. You as the lender and the borrower will wire in the loan and down payment amounts into escrow. If you ever get into a trust deed investment and someone's saying, yeah, just wire me the money directly, turn and run the other way. You always, always, always have to have an escrow intermediary handle the transaction. Okay? Escrow is also the entity that will have the trust deed or mortgage recorded by the county recorder where the property is located. Again, that's the most important document in this whole investment because it makes your loan a public record. All right, what happens next? The loan is funded. Now what? Well, you don't have to, but we recommend that you hire a loan servicer, right? You're going to evaluate them. We have a couple relationships with a few people, and I'll introduce you to them. But you're welcome. You jump on Google. There's hundreds of servicers, and they all pretty much do the same thing, and their fees are all about the same. Okay? The loan servicer will communicate directly with the borrower. You don't have to do any of that. The borrower will start making their monthly payments. Okay? They got a monthly payment. They make that directly to the loan servicer. So the loan servicer collects the monthly payment, and they remit it to you. The loan servicer handles all the correspondence with the borrower. I got some specific bullet points here at the bottom about exactly what that loan servicer will do for you to service your loan. Okay? Let me draw a parallel here. So if you get your mortgage to buy your primary or an investment with Bank of America or Wells Fargo, you don't know any different, right? They retain the servicing rights to your loan, so they send your monthly payment. It comes on Bank of America letterhead, and you actually make your payment to them. Now, they've already sold that loan to Fannie and Freddie or to some Wall Street firm, and so they collect the payment from the borrower, but then they just turn around and remit it after they collect their fee to the investor. So in this situation, we're hiring a loan servicer to handle that same intermediary section for you. Okay, what's the role of Marshall Reddick in this? All right, well, we've got the boots on the ground. We've got the borrowers looking to do the buy and hold real estate, okay? And we locate, evaluate, and provide the private lending opportunities to you. Okay, we communicate clearly with all parties. That includes the lender and the borrower. So we work with the borrower directly, take their loan application, source their funds, all the things that a conventional conforming lender will do. We're also going to coordinate with the realtor, inspector, and appraiser, coordinate with escrow or the attorney, some states are attorney states, and the title co. Again, we're definitely going to make sure the promissory note is in order. We're going to share it with you. We're going to make sure the homeowner's insurance is in order, and we're also going to provide the wiring instructions so that we can get the deal closed. We're going to connect you with the loan servicer after it's done, unless you have your own loan servicer. I work with a lot of people. They do notes all the time, and so they already have an existing relationship with the loan servicer. No problem. Now, knock on wood again, if there ever was a default, we are going to help you remedy that default. Again, we do that with our boots on the ground. Not only do we have relationships with the broker and the property manager in that market, we have relationships with attorneys in those markets, right? We have lenders and all of the team of real estate professionals you need in those local markets to help you. So if you ever do run into a default, we will gladly jump in and help you guys get the situation rectified. Okay. Anybody that tells you that investing with them, there's no risk or there's a risk-free investment, that just doesn't exist, all right? So while there's a risk investing in trust deeds and with our private lending program, we mitigate it substantially. Okay, so we always use an intermediary. I've been harping on this through the whole call, but it's escrow or an attorney, okay? We also always have title insurance. Okay, we lend only on Marshall Reddick approved property, in Marshall Reddick approved markets, to Marshall Reddick borrowers. Okay, we kind of control the whole ecosystem. Again, very, very favorable loan to value. That means that these borrowers are putting substantial skin in the game. They're going to do everything within their power to make good on all of their terms of the promissory note. They don't want to lose their investment, their 40% down payment. I mentioned homeowners insurance, and here on the screen is a couple of the loan servicers that I've worked with. I personally use Superior Loan Servicing right out here in Ventura, California. Awesome group. Okay, want to show you guys a couple of available opportunities. Now, we talked different ways, and the scenarios and how things work I just explained. That's providing a purchase money. So that's lending at the actual acquisition. The available properties I'm going to show you now are already loans that have been originated, that are performing, and that you could buy from us right now. Here's the first one, suburb of Atlanta, Georgia. Okay, so one of our borrowers bought this property, 99.9. It was just recently originated in May. Okay, so they picked the 10-year balloon note, right? So 30-year amortization, that monthly payment looks just under $420 a month. Okay, the balance left on that 3-year interest guarantee, again, it's only 2 months into the loan, is $12,500. Okay, so in the next 34 months, you will earn $12,550 in interest. Okay, again, the loan to value 60% because the borrower's down payment on this 99.9 was just under $40,000. You can buy this note today for $61,000. Okay, so you would pay the cash, the $61,000. You would then start collecting the $419.11 a month, and your annual return based on these figures comes right in at 7.35%. Now, I'd like to ask another question. We talked about this before. What is your retirement account earning today? Now, if I could earn 7.34% for the next 30 years, I would be jumping up and down because that is a fantastic average annual return. Second available note for tonight. Okay, we're going to go right back to our good friend Jim Moody. That this is a property that was purchased from him, purchased back in January of this year, $42,900 purchase price. This is a 30-year fixed loan program. Okay, monthly payments just under $200 a month. Again, that's principal and interest. You've got $5,400 in interest guarantee remaining on this loan. You can buy this today for $26,250, right? In exchange, you'll collect the just about $200 a month, making your annual return 8.25%. Pretty phenomenal deals if you ask me, and I see deals all day long. So, keeping the presentation as short as possible. If you guys are interested, you need more information, let's chat. Ed and I are going to be available tonight. If you'd like, shoot me a call. This is my office number. I've got Ed's number on here.
Thank you, Patrick. Thank you, Dimitri. Thanks for sharing your knowledge with us. We've got a whole bunch of questions that people have sent in. In the interest of time, I'm just going to ask 2 questions of Dimitri and then 2 questions of Patrick. The first question for you, Dimitri, was can I roll over my traditional or SEP IRA into a solo 401k?
Sure. Yeah. If you have a traditional IRA or if you have a SEP IRA, Roth IRA, you can get that rolled over into solo 401k. In fact, any qualified retirement account can be rolled over into solo 401k with one exception, and that one exception is Roth IRA. So IRS does not allow Roth IRA to be rolled over into 401k, but other than that, any retirement account can be moved over. Now, one important note is that employer-sponsored retirement accounts such as 401k, 403b, or 457, they must be with the previous employer. That's usually the rule. If it's with the current employer, you're still working for a company, they will not allow you to roll that over unless you over retirement age. All right.
Thank you, Dimitri. Second question for you, buddy. This person says they have a self-directed IRA with Entrust, and they're very unhappy because Entrust takes forever to process any investment transaction. So this person wants to know, can they roll over their self-directed IRA from Entrust into their own solo 401k?
Sure. Yeah, the answer will be the same. The fact that it is self-directed, it's still a traditional IRA or a SEP IRA or a Roth IRA. So unless it's a self-directed Roth IRA, then it cannot be rolled over. But if it's not a Roth IRA, then yes, it can be rolled over into a solo 401k.
I'd like to speak to that too, if you don't mind. I have a self-directed IRA as well, and I know exactly what that particular investor asking that question was dealing with because it takes forever to get an investment done. I mean, we're talking 3 to 5 days when you need the custodian to do something. And so from the custodian standpoint, I circumvented that by creating an LLC. Now, the IRA owns the LLC, but I'm the manager of that LLC, okay? So I told the custodian, basically, I want you to make one investment, and that's into the LLC that I created, right? Now I have the funds that it took me, 3 to 5 days to get the custodian to get the money into that LLC, but now I have checkbook control. I can write a check, deposit money into that, in and out of there, without having to deal with the custodian. So while I agree that solo 401k is more powerful, and if you have the ability to roll into that, you have the presence of self-employment income and those types of things, I encourage you to do it. If you don't, but you already have the Entrust, consider creating the LLC and obtaining that checkbook control. It's done wonders for me.
Thank you, Patrick, for plugging that in. It is a great option, and we do help clients with that as well, and just the same way as we helped you. Because of the limited time, I didn't have time to discuss that, but it is available, and if somebody is interested, we can discuss that certainly.
Thank you, Dimitri. Question to you, Patrick. One of the listeners wants to know, you talked about having insurance on the property. One of our listeners wants to know, how can you be sure that they've insured the property to the correct value?
Well, when it's a purchase money loan, meaning we're going in for their initial acquisition, we require a DEC page, and that's short for declarations page. So I would communicate directly with the insurance broker in the transaction. The borrower would make that connection, and they would know how much the loan amount is that you've made. And so obviously the property is going to be worth more than your loan amount. So we will make sure, and you can set the limits of the liability and the limits of the structure liability. If it's a $100,000 purchase, we're going to see that it has substantial coverage, and then we're going to ensure that it continues to have substantial coverage by adding you as the mortgagee. Now, what I mean by that simply is, think about all the conventional loans that are out there, right? If you look at if you've got a loan with financing, and you look at your insurance documentation that you get at your annual renewal, you're going to see your bank listed there as mortgagee. Now, what does that do? Every time there's a renewal, every time there's something going on with the policy and it gets mailed to the borrower to pay it or to do something, that same notice goes to the lender. So you'll know if the policy is in danger of being canceled or if the coverage limits are changing. You'll know what the premium is every year. That's the beauty of adding the lender as mortgagee. The insurance is covered.
Thank you, Patrick. The last question, one of our listeners wanted to know, for your program, what is the minimum amount that they can invest?
Well, probably the low end is going to be, this is based on the market too. Let's back up there. I mean, property values are different in all types of markets. Certainly, properties in Phoenix are more expensive than the properties in Toledo, Ohio. Generally speaking, we're talking about your average single-family home. But Toledo's probably our lowest purchase price market, and so I'd say $30,000 gets you into a deal. We also, important to note right there, that we don't add multiple lenders to one trust deed, I forget the term they call it, but we prefer to stick with one lender, one trust deed, all first position in this type of lending.
Good. Thank you, Patrick. So I see there's many people on the list that I've talked to here in the last couple of years. Looking forward to talking to the rest of you. I'd like to point out that there are literally hundreds of billions of dollars today in non-interest-bearing accounts at banks and at credit unions and Vanguard, Fidelity. I mean, literally hundreds of billions of dollars not earning any interest. If any of you find yourself in that situation, Patrick's opportunity far outweighs zero. So you guys should really consider it. So in the next few days, you're going to receive contact for some very nice young ladies. They're going to set up appointments for you to talk to myself or Patrick or Dimitri. We're looking forward to answering any questions that specifically to your own personal needs, and we're looking forward to trying to help you guys in any way that all of us can. So I want to thank all of you for your time tonight. Your time is very precious, and we appreciate you spending with us. So from Patrick and Dimitri and myself, good night, and have a great evening.
Thank you.